everyone, this is Dave Alison, and in today's video, we're going to be talking all about retirement income and investment losses. Now, none of us like seeing our investment values go down, but unfortunately, it is a natural part of stock market cycles. And we've typically seen that while we know markets go down, they do recover, and we should wait it out. And that is traditionally good investment advice. But when we've retired, the game changes a little bit, and losses could hurt more than when we were accumulating and saving money. And I want to walk you through some simple math here. Let's say that we had an investment portfolio and the market goes down and that portfolio loses 10%. Well, it would require an 11% return for us to get back to even. So we have 100,000 invested, we lose 10%, it goes down to 90,000. It would take a subsequent 11% return on that 90,000 to get us back to even. But what if we needed that portfolio to generate retirement income for us? And so in this case, we're taking 5% withdrawals out each year, and over a 5-year period, we have an initial loss of 10%. It would require a recovery of 44% over that 5-year period to bring us just back to even. That's the impact of taking withdrawals when you have an initial loss on your portfolio. To contrast it, let's imagine we had a portfolio and we lost 20%. Well, if we lost 20%, we would need a 25% return to get us back to even. But if we were also taking withdrawals off of that portfolio, again to the tune of about 5% per year, and we have an initial loss of 20%, it would require a 62% recovery just to get us back to even. And last but not least, imagine if we experienced a 30% decline in our portfolio value. So now we had 100,000 and it's worth $70,000. Well, if we're not taking any withdrawals, it would require a 43% gain to get back to even, which is somewhat common. After big losses, we tend to see big gains in the market, which is the rebound that we all are waiting for when you hear advice of just wait it out. But again, if you're retired and you're taking 5% withdrawals from your portfolio and we experience an initial loss of 30%, you would need a whopping 85% return over that 5-year period just to get back to even. And that's what's known as sequence of returns risk in retirement. It causes retirees to deplete their account values when we do have a down market, and is one of the reasons that retirees could run out of money. And so we believe the solution to that is what we call the bucket plan. With the bucket plan, we're simply time segmenting your money based on the purpose. The now bucket is essentially money in the bank. It's off the table from market volatility. It's up to a year's worth of income so that if there is a downturn in the market, we don't have to take any withdrawals from your market portfolio. The soon bucket is going to be invested for growth to help offset inflation. It's just going to be invested more conservatively, and it's designed to provide reliable income and withdrawals through that first phase of retirement. Now, last but not least is the later bucket. Because of the now bucket and the soon bucket, we've effectively bought a time horizon where we're not going to need to take any withdrawals out of the later bucket, and we can weather any of the month-to-month, quarter-to-quarter, even year-to-year market volatility. We can have the later bucket structured to try to maximize growth without having to worry about withdrawals for retirement income, because the now bucket and the soon bucket have your income covered. So if you have any questions about a proper retirement income distribution plan or navigating market volatility, I highly encourage you to reach out to us or one of our advisors. We're here to help.